Welcome to Money Script Monday. My name is Andrew Keene, and today I'm going to show you how implementing a family banking system into your financial plan will allow you to enhance the returns on all your investments. It not only enhances your returns on your investments, but it also preserves your wealth. It generates tax-free passive cash flow. It adds financial protection for you and your family in case of long-term care needs or critical or terminal illness needs such as a heart attack, stroke, or cancer. It protects you from stock market losses, tax increases, and inflation. It always keeps your money compounding even though you're using it elsewhere. It allows you to redirect the payments you're currently sending to banks and credit cards back to your own economy, and it increases the velocity of your money, and it speeds up your wealth building. Now today we're going to look at the difference between paying cash for a real estate investment versus using a policy loan from a life insurance policy set up for a family banking system. And you're only making one small change to what you're currently doing. Now this same strategy can be used when you're investing in anything, including the stock market. Now most investment opportunities, even great ones, put your money to work in only one place. You put your money in, you earn a return, and you take your money out. Now traditionally, if you put money in the stock market, it's only working or losing in the stock market. When you put money into real estate, your money's only working in real estate. Now life insurance is called an and asset because it offers the unparalleled opportunity to put your money to work in multiple places simultaneously. Permanent life insurance offers a unique opportunity to borrow against the policy. When you borrow against the policy, not from the policy, your cash stays inside the policy and continues to grow uninterrupted compounding interest. This means that once a dollar crosses into your policy, you can earn value on that dollar for the rest of your life, even though it's being used elsewhere. Now, when you borrow against your policy, you can use that money for anything. And if you choose to invest it, such as in real estate, the stock market, or your business, not only does that asset that you bought grow in value, but the money stays inside your policy and continues to grow in value. So now your money is growing in two places at the same time. The and asset increases the velocity of your money and it speeds up your wealth building. Now today we're going to look at buying a real estate investment. The purchase price is $100,000. The term of the loan will be 30 years and it's $1,000 rent. Now I'm keeping the numbers very, very simple for our example today. And the first thing we're going to look at is market value. And again, this is very simple math. Now to demonstrate the future market value of this property, I'll utilize a future value calculator. Now the calculator demonstrates a house being purchased today is valued at $100,000, and the value of the house will increase in value at 4% over 30 years. At the end of 30 years, the market value of the property will be over $324,000. Now the other thing that we want to look at is cash flow. In today's scenario, the cash flow is $1,000 a month in rent, so $12,000 a year for 30 years. So we've got a total of $360,000 in cash flow. So the value of the house grows by $324,000. The cash flow is $360,000, and we've got to subtract out the home's purchase price. So the total increase in wealth over this time period is $584,000. Now let's make the same comparison using a life insurance loan from a properly structured life insurance policy. So for simplicity, we're going to assume we save the $100,000 inside of a life insurance policy instead of a bank account. We established that the house's market value after 30 years will grow to $324,000, and we know the market value stays the same regardless of where the loan comes from. But the cash flow is different. If you take a policy loan, that means you're going to have a payment that goes back to the life insurance company to pay off that loan. But here's how this works. You borrow $100,000 from the life insurance company just as you would borrow money from a bank. Now the interest rate that you're paying the life insurance company is 5% simple interest. And the money inside of the policy continues to grow uninterrupted. Now we've got to take our $1,000 a month and subtract out $465 a month. And we have a monthly payment of $534. This goes back to the insurance company. So instead of $1,000 a month cash flow, the cash flow is $465 a month for 30 years. So we've got a total of $167,000 in cash flow. Now you may look at this and say, yep, this doesn't work because we've got less than $584,000. But here's where the policy loan comes into play and becomes very valuable. So even though you have a policy loan, that full $100,000 cash value is still earning interest and is growing. So let's go back to the calculator. We're going to show that $100,000 is earning a very, very conservative 4% return. And over that 30-year time period, that $100,000 grows to $324,000. Now remember, you have access to this cash tax-free, so it's like getting a 6 to 7% return on your money inside of a taxable. And I do want to note, these work more like a line of credit, because as you put the money back into the policy, you have access to that money. Now the $100,000 you left grew to $324,000. The market value grew to $324,000. The cash flow is $167,000, and it equals a total increase in wealth of $816,000. But we've got to subtract out the cost of the house. So the total wealth has grown so far to $716,000. So that's a $131,000 difference. The only thing done differently was save money inside of a life insurance policy instead of a bank. By using a policy loan for one real estate deal, you see there's more cash at the end of the investment. Now remember, you can use this same strategy for investing in other assets as well. This is the power of a whole life policy. So this looks fantastic, and it's clear that a policy loan is better. But we aren't done yet. Now remember, the cash flow was $1,000 a month. $535 went to the insurance company, but what happened to that other $465? Now, where do most people put that cash flow? Most people are going to put it in a bank account, which earns next to nothing, or they spend it. Well, we put it back into the policy, and it grows in value at 4% a year for 30 years. When we do the math, look at what happened. So we take $465 a month and earn a conservative 4% over 360 months. That's an additional $323,000. Now, to be fair, we must take out the cash flow number of $167,000 because we already counted the cash flow back into the policy, but we didn't count the growth. So we remove the $167,000 and replace it with the $323,000. Now remember, you have access to this money tax-free. And even if you decided to never put another penny in, this money is going to continue to compound every single year. And it provides you with a death benefit, long-term care protection, and protection for critical or terminal illness. Now, if this strategy adds this much additional wealth with just one property, imagine the wealth difference it creates with multiple properties. Now, this is just one example of how to increase your untaxable wealth. There are many other opportunities out there. This strategy can be coordinated with retirement planning, other businesses, business succession planning, and other purchases you make during your lifetime. If you want to learn more about protecting your assets, how to generate tax-free passive cash flow, how to increase your wealth, or if you want to learn more about a family banking system, reach out. Thank you.